Hello, everyone, and welcome to Behind the Buzz, Digital Assets and the Crypto Conundrum. And I'm really excited for us to be together today to talk about what I think is one of the most exciting trends that we're seeing in the financial services area and indeed the broader economy. This is an area with a lot of rapid innovation, a lot of big ideas, and you've seen banks, fintechs, large technology companies, and a whole wild west of crypto native firms, all making big investments and big claims in this space. But I think it can also be an extraordinarily confusing space. Depending on who you talk to, crypto assets can be either positioned as a panacea to all the world's woes, including financial exclusion, or they might be called a Ponzi scheme, as well as a lot of much less polite terms. Fortunately, today we've got the right folks with us to help us distinguish fact from fiction and understand a little bit about the impact that these new innovations could have on the financial economy and the broader project of financial inclusion. I'm joined by my colleague Raj Dhanamodran, who is leading all of MasterCard's cutting-edge product development in this space. And I'm joined by my former colleague, Sheila Warren, who leads the World Economic Forum's work on data, blockchain, and digital assets, and who is also the host of the very popular weekly podcast and television show, Money Reimagined, which is hosted by CoinDesk, and which I strongly recommend those of you who are interested after this session check out. They're going to help us to explore the difference between speculative crypto assets that function as an investment and stable coins that are designed for payment. They're going to help us understand some of the myths and the facts in this space and dig into the question of where and when these assets can play a helpful role in driving financial inclusion. And so, without any further ado, I'd like to invite Sheila to kick it off for us. Sheila, can you talk to us a little bit about the lay of the land in this space? There's a lot of big claims that are getting made about the transformative impact that financial assets like these could have. But it's a little bit difficult to sort of figure out the distinction between fact. Can you provide us with a bit of a guide?
Sure, Jesse, I can certainly try. And I'll note that this is the question, is it not? And so I think it's important to kind of start with some context setting. The reason that there is so much attention being paid to financial inclusion in crypto, this is one of the major talking points you often hear in this ecosystem, is because we have a big problem around financial inclusion. And it's important to note that legacy systems, even with recent very promising innovations, have not solved this problem. And so that's an important kind of context to set. And so I think we have to evaluate the efficacy, the efficiency, and the impact of crypto solutions or blockchain-based solutions within the context of recognizing that this is an ongoing systemic problem that is a nut that no one's cracked. Now, just quick numbers. 1.7 billion people without access to banking services or even basic financial services. UN OCHA estimates that 235 million people around the world are going to need humanitarian assistance and protection in 2021 to the tune of $35 billion that needs to be deployed in those places. There are not currently hyper-efficient, effective ways to get these resources to people who need them. Now, all that being said, I do think we have to recognize that no technology, period, no matter what it is, no matter how innovative it is going to be able to, on its own, crack this problem. That is just not the reality of the issues that have been identified in this space. I'll quickly run through some of the problems that we have as a general matter, right? We have a lack of access and infrastructure. So of the 1.7 billion unbanked, 1 billion do have access to a smartphone or a phone of some kind, but oftentimes it's a selection of a feature phone because of cost issues. So may not have access to some of the mobile devices that we take for granted in more developed ecosystems. There are big issues around last mile connectivity. There are big issues around digital identity, whether or not people have any form of identity that is issued by some authority, whether government or otherwise, let alone whether the identity is actually digital in a manner that would enable them to access a digital system, right? So all of these are precursors to even engaging in a crypto ecosystem. There's also the requirements around regulatory compliance, EKYC, know your customer rules, anti-money laundering rules, There was debate going on about whether these rules are appropriate for our new environments. I'm not going to weigh in on those. I personally think those are decisions held by regulators, and they're held at a global level. Regardless, there is opportunity to kind of think through how we might work with those regulations to provide adequate compliance, but those barriers are expensive to comply with, and that remains the case regardless of systems. And then lastly, something that we've spent a lot of time thinking about at the forum is really this question around the ethics. Is it ethical to experiment with a brand new technology in some cases with a population that maybe is not going to be guinea pigged for that a little bit, right? And is there an element to which maybe we need to be looking at the infrastructure to become more robust, which it has in recent years, before we engage in that kind of experimentation? So I would argue that it isn't necessarily indicative of direction of travel, what the current state of financial inclusion is, and that may be in some cases in part because of an ethical and moral responsibility on the part of providers to make sure the technology was safe and secure and robust before deploying it in context. So I didn't even get into what are some solutions that exist, but I think it's really important to context set, because it's very easy, I think, to point fingers. And this goes for all sides of the financial ecosystem. Why aren't we serving these people? Should be these communities and people should be the threshold question of paramount importance. And oftentimes we get caught up in the semantics. At the risk of running over my time, I'll switch into what are some things we are seeing that seem to show potential. And I think we're in a stage where really we're seeing potential. Most solutions, if you want to call them that, again, they're pieces of a much larger enabling environment, are subscale. So we're really at the earlier days, I would say, of some of the opportunities that exist in this space. But just to kind of run through some examples for people to go kind of look up if they're interested, quite a bit of work by international organizations in this space. The kind of best known, I think, program is the World Food Programme's Building Blocks program, which provided digital wallets essentially to humanitarian organizations looking to basically avoid duplication of aid and provide more agency in aid. Mercy Corps, Kiva, UNICEF has a crypto fund that's looking at this. Oxfam has something they call Project Unblocked, which is a cash case study to look and see if this could be effective in natural disasters to get aid more quickly and efficiently dispersed to different places. We've got examples across the World Bank. And then, of course, the Red Cross, others. So IOs are seeing a lot of activity in this space. In addition, I think crypto protocols themselves, Celo, Stellar, Algorand, have launched some interesting pilots in various places. Cowrie is an example of something which is looking at in Nigeria at various opportunities that exist in terms of provisioning of access of financial services to various people to use it using cross-border payments and experimenting in that case. And then I can just run through a couple of quick other ones. Benusu is one we're looking at, another platform that's looking at creating a digital asset and offering non-custodial financial services to those who have not been able to engage in financial services due to lack of access. The last point I'll make, and I know I'm really going long now, is that I don't know that our goal should be framed as banking the unbanked, because I don't know that we're always going to have formal banks that are going to wind up being the end game for a lot of people who have been historically excluded. I think it's possible that we may have almost parallel systems with on and off ramps, right, that may exist in more aggregated community level models. And that's something I know MasterCard's, a lot of payment companies are looking into this. And so I hesitate I appreciated that the term historically excluded has been used throughout this day as opposed to unbanked, because those are different things. And I think we have to keep our eyes on what the goal is, which in my mind is to provide basic financial services to people that haven't historically had them, as I would argue a form of human right.
Thank you so much, Sheila. So I think if I'm hearing you correctly, we should be looking to resist the temptation to view technology as magic. Financial exclusion is a complex issue with social, political, and technical dynamics to it, but that there is something exciting here, that these new technologies do have the potential to drive value if they're integrated into a sort of a 360-degree approach, and one that's potentially not modeled on the traditional structure of the financial system. Raj, as someone who sits at the sort of of actually driving exploration into those models, tinkering with these technologies, if you will. Maybe you could talk to us a little bit about the areas that you're most excited about, where you think that organizations like MasterCard and our ecosystem partners have the potential to really move the dial and drive further inclusion using these and other tools.
Yeah, thanks, Jesse. And I absolutely agree with what Sheila talked about as the key building blocks necessary for financial inclusion before even we get to the crypto. The identity, last mile connectivity, absolutely are the number one things to look at. And I'll come to talk about some of the efforts in MasterCard's efforts in that area in a bit. But we are about talking about crypto. It may make sense for us to take a little bit of a scan of the assets that are out there and see their suitability for financial inclusion or not, right? So we largely can put all of these assets or currencies that we have into three large buckets, right? We have this, the bitcoins of the world, which are really supply and demand based, and we have the stable coins of the world. And there is more recently, there is governments around the world are exploring different types of central bank digital currencies. If I were to, at the fundamental level, financial inclusion is access to financial services also means that you're getting access to currencies and money that is stable and formed, right? Just by that account, I wouldn't put. There may be a lot of speculation on the bitcoins of the world that is happening at the moment, and it is definitely an investment asset class, and people should think about it. It is not the product that I would think as a key building block from a financial inclusion, purely on stability basis. There are a lot of great things about Bitcoin and Ether, and we can spend another forum talking about how the technologies they unleash build completely new industry. But coming to financial inclusion doesn't quite fit the bill, right? And then if it comes to stable coins, again, it can be a building block, like you said, Jesse. There can be a payment instrument. It can be used to move money. But again, the systems through which they're available are quite volatile, if you will. If you were to move a stable coin on a public ETH network, I'm not sure whether I can move the money or anyone can move the money in a financially inclusive way in a low cost because of some of the dynamics there. And finally, central bank digital currencies again could help. Is ultimately they are government-backed currencies that could be used to distribute aid and so forth. But all of that could become, vehicles only if you're able to solve for this two or three key building blocks: identity, a verifiable identity, last mile access. I will also say another factor, and if you financial inclusion is about reaching people across the spectrum inside a country, and ease of use of whatever we put in front of them, and the consumer experience need to be very, very simple. So coming back to what MasterCard is doing about it, we are obviously focused on identity. We have this identity hub product that we've been working on connecting various governments on. We have recently looking at additional Ikata, which is an acquisition that we made recently in this space. So our job here really is to help connect with the providers of identity to the users of identity, so that can be simply solved for. And the next building block, obviously, is the last mile access. Fortunately, we are connecting. We have billions of cards around the world, and the connectivity in remote parts of the world in terms of acceptance, that can be a key building block. So if crypto were to come an instrument for distribution for any of these consumers in a financial inclusive way, we can definitely facilitate that. But I think we are focused on building blocks prior to that before we would put crypto in front of the consumer on a financial inclusion basis. There are other use cases where crypto is great for, and we're working with industry on a number of those. And if we have time, we can unpack that later on. But from a financial inclusion basis, I'm very much aligned with what she, and we are focused on those building blocks at the moment.
Thanks so much, Raj. So it sounded like we an identity for people. We need an intuitive user experience, and they need an asset fundamentally that's not a speculative store of value that might make them rich years in the future. Rather, they need a stable payment token that they're going to be able to use with merchants and others. Presumably one denominated in their local currency, so that it's not creating macroeconomic disruptions. And those are really kind of some of the things that we need to be bringing together. Sheila, you want to jump in on this?
I just want to chime in on that last one, because I think that's a context. There's a context dependency there. So you need a underlying asset that is less volatile than whatever the default asset is in the jurisdiction. That's a really important distinction, I think, to make, because in some jurisdictions, Bitcoin or Ethereum or whatever might actually be more stable than other options. Those cases are admittedly rare. Nevertheless, they do exist. And so I think for completeness, we should say that. I also think it's a matter of the time of holding. So one of the early examples of a very, I think, extremely valuable experiment was how to create currency pairs across countries that hadn't necessarily had capital markets. And the idea that you could trade via Bitcoin, and that because of the time needed to exchange, whatever, a Naira into a dinar, whatever it was, right? You could do it so much faster using Bitcoin specifically. And so you could take advantage of currency arbitrage, for example, in those jurisdictions that you couldn't before. Now, again, that's more of a high finance, let's call it, opportunity, as opposed to one aimed at financial inclusion. Nevertheless, in opening up new markets, there is a theory, at least, that will lead to a greater standard of living, more use of that currency, more consideration of it as being globally important, et cetera, that could be valuable to various communities. So I just want to put that out there. If you're holding this and you're really using it to just basically as an exchange kind of mechanism, the volatility of the underlying currency may not actually be what's of critical importance. It may actually be the time to completion and finality of a transaction that becomes of paramount importance.
Yeah, I think if I may add to that, Sheila, I think it's a good discussion and debate to have. You're absolutely right. If somebody were to go in and out of a transaction within seconds, does the volatility matter? But we also need to look at kind of the recipient's use of that proceeds and how long they were going to use it, and what else they use it for, and how the further recipient, let's say they go spend it in a merchant for something that recipient have paid, and how they use it. I think it's an end-to-end consideration. These all can be part of the answer, but I think the view is that key building blocks need to be in place before. Is I think the point? Yeah.
Totally agree with you.
So we've talked a lot so far about social dynamics, which is obviously the order of the day here. But if you open up a newspaper and read about crypto, you'll often hear some very disturbing references to its ecological impact, particularly around certain types of assets having, you'll hear, the same electrical consumption as Ireland or whatever the reference country of the day is. Sheila, maybe you could guide us a little bit through this. Are we at risk of trading off the S for the E in ESG?
Well, that's an interesting way of framing that question, Jesse. But let me start by the comparison, and there's kind of this parlor game, where you can kind of look at the energy use of the Bitcoin ecosystem and which country of, energy usage is it compared to today. And so, I'll say I'm a lawyer by training. You give me any two things, I can find a way to compare them that will sound plausible. But in my mind, this is kind of an apples and zucchini comparison, right? I could compare anything again. So I don't find it to be particularly useful. What I think is important to note that I think is evidence-based is that Bitcoin is energy intensive. That is factual. That is very true. And I also think that Bitcoin miners, which is where the energy usage comes from, we don't have to get into what that means technically, but just suffice to say, there's one part of the ecosystem that is the reason that there is so much energy use within this. They are motivated to find the cheapest sources of electricity, energy. And there are ways to incentivize them beyond their existing incentives to seek out renewables and other kinds of sources. And so in my mind, the best efforts are spent not on the pretense, which I think is at this point we can acknowledge an illusion more than a decade into this, that Bitcoin's suddenly going to stop being mined, which is just not going to happen, but more how do we ensure and how do we create incentives to make that operation as clean as it can be and to hold accountable the ecosystem for showing demonstrable progress in the use of renewables and others in the ecosystem. So want to just make that point first of all. And then I think you ask a very interesting question. Is there a trade-off, between E and S? And I would say to the extent that we believe that crypto or blockchain-based systems or Bitcoin, and you have to look at these distinctly, really important to note, not all cryptocurrency is Bitcoin. There are different underlying protocols. They have different trade-offs. The energy angle is one consideration among other considerations. So the extent that we think crypto either is or has strong potential to address the needs of those who have been excluded from financial systems, and in the consequences there, poverty, fleeing status, more affected by climate change, like all kinds of horrible, horrible things. I think we have to look at everything holistically. And so I don't know that I would ever want to say the environmental cost is something, and we look at that. I mean, how would you even measure that, right? Like this many lives, this many, it just isn't a comparison I think any of us would be morally comfortable with, or even could even realistically make. Nevertheless, I think that when you look at the system at the present tense, yes, the sustainability issues are significant at the moment. And yes, the social impact remains to some extent subscale and in some cases unproven as of yet. But if you look at the trend lines, I do think that you're seeing more and more adoption of renewables and greener sources of energy. I think you're seeing a lot of effort by the industry and others to ensure that there is accountability around that. And then that trend continues to dramatically accelerate. We've already seen a lot of improvement. And I also think that you're seeing a renewed commitment from some parts of the ecosystem. Important to note, I would not paint a broad brush here. There are some people who are more sincere in their intentions and attempts at this than others, just the nature of the beast. But I think we're seeing that too. And I would hate to think that in these earlier days of experimentation, we would potentially risk cutting off what might have powerful implications for historically excluded people because we were trying to stop a system that in my mind is already that cannot be stopped, basically, right? Like no one's going to stop mining Bitcoin, and that's also a reality.
We've talked a fair bit here about mining Bitcoin. How should our viewers be thinking about the energy intensity of crypto? Is it all sort of pretty much the same across the board, or are different protocols sort of using very different levels of energy?
Yeah, and look, I think it's a good, Sheila makes a good point that Bitcoin is here to stay and it's going to be mined. So she's making an argument, let's go find energy that is cleaner. I get that point. But from the spectrum of crypto assets that are available, not all of them are built using what the industry calls as what is called as proof of work that requires intense electricity. So there is consensus right now in the industry that over time we want to move towards technologies that reduces the energy use. In fact, Ethereum network is moving towards a proof of stake, and there are other public blockchain networks that support various types of crypto assets that are not based on proof of work at all. Some of the other public networks that are out there. I think we are going to also see solutions evolve outside of this proof of mining-based networks. I don't want to get very technical here, but there are side solutions and layer 2 solutions that are available that are actually do not use a Bitcoin network, but can still move some of those assets. So I think the trend is that some of these issues are getting solved, but it is something to watch out for in terms of the energy that is used to confirm a very basic set of transactions in the core Bitcoin network. But I think there is a lot more that can be done on using crypto technology that doesn't involve a lot of energy.
And so for our less technically inclined viewers, might it be suitable to say that crypto assets today might be thought of as being in the Studebaker era, and that's not to preclude the fact that in the future we might see more energy efficient vehicles, we might see hybrid vehicles, and perhaps someday there'll be a Tesla of crypto assets, somewhere in the future.
That's a good way to talk about it.
I might push back on the brands used, but yes, I think in general, progress is being made. I should also note, I think it's important. Progress is a priority on this topic. This is not something you may hear people who are ardent defenders of the system to the death or whatever, but I really think that progress is a priority here. Progress on sustainability is a huge key issue in the industry. It's something that's talked about all the time. And there's a lot of attention being paid to this. And so I do think this is ultimately going to be a problem that you're never going to use. It's never going to be, I don't think, net zero. I mean, I think there's aiming for that, and there's definitions around, is net zero even the right metric and all of that, which we can whole other conversation. But I do think that, this is a solvable problem in terms of major improvements. Yes.
Great. Before I go on to my next question, I just want to invite the audience. We'll be transitioning in a few minutes to a bit more of a dynamic Q&A discussion. So I'd invite you to join the chat, which you can find on the right-hand side of your screen, and put in any and all questions that you might have. There are no stupid questions, and we'll do our best to tackle them. Raj, one of the things that we talk about a lot in the payments industry is the foundational importance of trust to payments. Trust between the payer and the payee, that the transaction is going to go through, that it's going to be denominated in an asset that's going to continue to have value, that someone in the middle isn't going to invalidate that transaction or subject one of the counterparties to fraud. Obviously, as we move into the crypto asset space, it's a new frontier, and that presumably exposes us to new risks. And when we think about this from the financial inclusion perspective, that feels particularly important for us to pay attention to, given that often the counterparties in these transactions may be those most vulnerable to even small denomination losses. So how can we think about that as we move forward in this space, about safeguarding those sort of consumer, maintaining that basis of trust?
Yeah, very, very important question here, Jesse. And let's talk about where the trust comes from. There are two angles to unpack here. One is the trust comes from people believing that the set of parties they interact with are known, and there is a certain level of protections that are available for them to interact with that system. So a lot of what we talked about in terms of reliable infrastructure, identity, all of that contributes to getting trust into a system. Often, crypto world is talked about as somewhat trustless system that solves all problems. And centralized systems are you need to trust an entity. But I would simply submit that even in the distributed decentralized world, what you're trusting is really that over time wisdom of crowds, and let's get logic, but can be trusted. It has gone through all the checks and balances necessary for it to be done, and there are and then you can trust the logic of that, which is not really true. As if you see a lot of the hacks that are happening in the crypto world, you often people find issues, bugs, as they call it in the software world, and that results in loss of money. So I do believe that there is a role for people to play, whether be it governments, be it institutions like us, or be it people who are providing a curated experience, if you will, that introduces trust in the space. That curated experience can come in the form of identity verification, come in the form of transaction types that are fully backed. For example, if there are errors, if person A is dispersing money to a person B in a country, and let's say you send the money to the wrong person because the identity was not right, you need ability to reverse that transaction. You need ability to correct that and course correct it and move forward. So it doesn't matter whether it comes from a centralized entity or comes from a set of cooperating set of industry participants. That kind of trust is necessary. That kind of mechanisms are necessary for aid to be distributed, and for to make sure that it and then once the aid is received, they can actually spend it with a level of assurance. So we believe our for example, our current network provides that. We are certainly committed to bringing the same level of curated experience, if you will, that provides the level of protections to the financial inclusion use cases as well. Our disbursement, cross-border remittance, all of that products that we have are really built on that foundational principle. I would say that this trust even more the issue of trust and issue of ability to correct issues is even more important in this financial inclusion world than compared to the regular commerce. So that would be my view.
Sheila, any additional comments that you want to add here?
Yeah, it's a really ongoing debate, and I think, again, it's context dependent. There are some parts of the world where I think institutions do not have the public trust. And so alternatives that are based on machines or code or whatnot can seem immediately attractive. And there are other parts of the world where those institutions may not be beloved, but they aren't necessarily, they haven't necessarily proven themselves to be untrustworthy in the same way. And I mean in terms of security and finality of transaction and things like this, right? A corruptibility, this kind of thing. And so again, I think this is a context dependent analysis, and certainly we can make broad generalizations about what generally exists when it comes to even central banks or other kinds of institutions. But I do think it's important to note that particularly when we're talking about for the financially vulnerable, oftentimes they are in jurisdictions where maybe, or in environments where maybe those same assumptions don't necessarily apply. And so it's a challenge, it's an ongoing challenge to say to what extent, as I noted earlier, do we have an ethical obligation to make sure that we have kicked the tires, and at what point have we done that sufficiently on any new innovation, technology or otherwise, before we feel that we should be rolling it out, in a pilot model, versus to what extent do we feel enough confidence in those systems because of their architecture for whatever reasons, or their community, to Roger's earlier note, they're kind of crowdsourced in terms of some of these concepts, that we feel that we can do so. And then, of course, the counter to that, the corollary is really, well, how do you learn if you don't do the experiment? And so, it's always a difficult choice to make, and one that I frankly don't envy builders in this or any space.
So I'm gonna, if I can, tie this to a question that we've had come into the comments, about sort of running fast and making sure that things are stable. But a question about the much covered introduction in El Salvador of Bitcoin as a parallel form of legal tender alongside the sort of longstanding use of the U.S. dollar there as legal tender. So very interesting and somewhat controversial announcement, and one that was they looked to deliver quite quickly, I think over about a 90-day period, and one that has had a few technical growing pains. Sheila, I'm kind of curious what your thoughts are on a system like that. To what degree do you think that's a fit to the sort of the model that you're thinking of in terms of countries where this might be appropriate? And is that maybe the choice that you would have made if you were sort of recommending a crypto assets policy for El Salvador?
Okay,
really
it's going to be a long-winded answer, but you knew that when you asked me. So here we go. Okay, strap in, everybody. Yeah, no, I think look, there's a reason I think a lot of these experiments have remained subscale, and I want to say, from where I sit, I don't think being subscale is necessarily a problem. I think that issues around financial inclusion are extraordinarily context dependent, more than in many other issues that we deal with as a society. Therefore, we should maybe expect that solutions that are fit for one environment will not scale completely or whole hog to another environment. Maybe aspects of them will. But again, because of the complexity of what we're talking about, that I think we've well articulated in this session, it is probably naive to think that there's going to be an ability to achieve scale, particularly across different jurisdictions. Now, in the case of El Salvador, what I'll say is when you look at where things began there with the so-called Bitcoin beach, that was an example where you had a small group of people who lived in a community, who were well known in the community, who built up trust in the community, who slowly introduced Bitcoin as an opportunity in that particular community in a very structured, I would argue, way, and that had traction and success. And in my mind, from having kicked the tires on that a bit, I think that is a success we should be talking about more than we do. That was then taken and scaled across an entire country that has different. It's a small country, nevertheless, but it has different context, urban centers, rural places, these are not the same thing. Merchants have different expectations across there's different user experiences in different places, a lot of things that are not the same. And so it remains to be seen whether that particular innovation is going to catch fire, across an entire nation that is comprised of very different populations that have different concerns and different needs. And it's one we are watching closely. Now, and then when you expand from El Salvador into the broader world, there is a very open question as to whether, even if that experiment is proven to be wildly successful, there are political implications to following, suit there. And so I have been skeptical from the beginning that those political reasons alone would not be sufficient to prevent, in some cases, adoption of the particular solution that has been rolled out there to other jurisdictions. Again, we will see. Time will certainly tell. But I think it's just the point I want to land is that I don't think it's a failure if we see subscale, quote unquote, experiments, because let me tell you, they're certainly relevant to the people whose lives they are benefiting or improving in some meaningful way. And in my mind, if we had a series of maybe only roughly connected such projects that worked in different parts of the world, that would be in and of itself very exciting and something that we should be paying attention to and celebrating where appropriate, but also pushing and holding accountable those providers to see, is there a way to make those more robust? Is there a way to think about what modifications or adjustments might be needed, whether those are technical, whether those are in the UX, whether those are in the policy, whatever it might be, to enable the benefits such as they exist to extend to others in other parts of the world.
I think that's quite sensible. And I think in the case of El Salvador, a lot of the growing pains around the rollout of Revolt, not so much around the sort of the underlying crypto asset itself, but rather around the user experience that was somewhat hastily sort of struck and stood up, and that didn't necessarily scale. Raj, any comments on this, or?
Well, yeah, no. I think my view, it's more of my personal view than like MasterCard's point of view here is like you noted, they already have US dollar as a tender in the country, right? It's a country that's trying to attract more capital into the country. Enabling another popular form in the form of Bitcoin actually certainly helps, right? I think that is getting another asset into the country that what they may over time in terms of value. But I agree with the comments and considerations that Sheila is talking about. And a plug here for MasterCard would be that no matter what the asset is, underlying asset is, we can provide access to it through our network, and that reach is available as long as we kind of take care of all the safety, security, trust, and predictability and all those angles that we talk about. We can provide access. So when CBDCs came in Bahamas, we provided card. We were one of the very first companies to provide a card access to that, making that sand dollar instantly accessible everywhere in the country. And that kind of actually can help some of these solutions scale because they wouldn't face the growing pains of actually building the network from scratch, if you will, if you were to put all of that acceptance from the ground up.
I think Raj, you touched on a really important point there. That is the point of interoperability between payment systems. We in our systems today enable crypto cards that allow folks to quickly through a partner crypto exchange to liquidate their assets and then sort of move those via traditional fiat rails, sort of enable them to spend those crypto balances at really anywhere a MasterCard is accepted. I'll use the chair's prerogative here just to respond to one of the questions that I've seen in the chat, because it sort of very much fits within my sort of area of interest. And it's the question about whether or not regulations needed in this, or as the asker said, before the impacts and benefits can be fully understood. And I think what we've really seen in this space, and what I think we're likely to continue to see, is regulators looking to walk a fine line between enabling innovation and ensuring protections at the consumer level, protections at the criminal level, and protections at the financial stability level, all of which are increasingly concerns in some corners of this space. And so I think what you're likely to see is, we've already seen progress in that most regulators are clearly aligned on the fact that some degree of anti-money laundering and know your client protocols really need to be in place around these assets. You've seen the Financial Asset Task Force, which defines standards for that, increasingly roll out more nuanced guidance about how specifically money laundering and those sorts of things, terrorism financing, should be cracked down on within the crypto space, how it should be effectively monitored. And then I think you're seeing now increasingly sort of thoughtful dialogues happening around the various types of sort of more innovative assets happening in this space. A lot of exploration of DeFi or decentralized finance happening. And I think that you're going to see this gradual and progressive roll forward of more and more of the regulations in this space becoming clear, preferably in ways that enable ongoing strong innovation, but that ensure that we have the right stability and protections in place. We're getting close to time. So what I'd like to do is, as we wrap up, ask both of our panelists to tell our audience a little bit about something that you're excited about. What's a thing that you see happening, maybe at the just sort of the initial germination within the crypto space, that you imagine over the next few years could have really notable impacts, not just impacts in terms of financial increases in value, but in terms of broader social or environmental impacts that it could have, really to do good in the world. Sheila, let's start with you.
Yeah, easy answer. DAOs. DAO stands for Decentralized Autonomous Organization. They are and effectively what they are is a new form of governance. They use a token mechanism to grant rights to token holders who then have essentially votes within a system, within a particular ecosystem. Those might relate to changes in the code or changes in protocol around it or something else that might be relevant. And leaving the specifics of that aside, I actually am a kind of a corporate governance nerd as a general matter. It's from earlier in my career. And I find DAOs to be the single most exciting thing that's happening, because I do think some of our current corporate governance, like our current system, is failing quite a lot of people. And if we have opportunities to think about a more inclusive model that DAOs could, in theory, provide, we'll see how they develop and grow and what structures come into place around them. I think that could have implications across frankly, the entire business community in terms of what requirements we might put into place. The forum has a whole notion of stakeholder capitalism that's pretty powerful. It's been developed over the last decade. And I think DAOs are one of the ways to manifest that concept in a very productive way that empowers a much broader set of stakeholders than those that are traditionally empowered and have agency within our current systems today. So very excited to see what happens there.
Interesting. Raj, how about you?
Yeah, DAO is very interesting for sure. So what I'm really excited about is at a more fundamental level, what this digital ecosystem is really enabling the tokenization of everything, right? It is what we are talking a lot. What we mean by tokens is a digital way of representing something else in the real world. That's really what we call on the tech side as tokens. But the importance about that is, as things get tokenized, a lot of there is buzz around NFTs. NFTs, in other words, is just simply a way of representing the right of owning a digital good today in this technology. And the reason people are so excited about it is something about that Sheila said that I want to connect. It puts the power back onto the people, of the creators or the originators of that art or whatever that may be. It could be a real world asset over time. It puts the power back in them, and they are able to set the economics around it. So I think we are in the very beginning phases of it. I'm quite excited to be part of this time and working in this space to see what else could come. And this broad tokenization, and once it comes into this technology, this distributed ledger and the blockchain technology, once the tokens come, I think the amount of innovation that can happen as a building block is going to happen for decades to come. And I think we're just starting on this.
Well, there you have it, folks. Crypto assets, they may not be a panacea, but they're certainly an exciting area of innovation, potentially to drive some, it sounds like, pretty transformative change. And combined with a broader vision of the problems that we're trying to solve, could have a really significant impact on the future of delivering a more inclusive financial world. I want to thank our two panelists, Raj and Sheila. This has been a really interesting discussion. Thank you for sharing your insights. And I want to thank the audience for joining us today. I hope that we've left you with some interesting ideas and some new insights into this exciting space, and wish you an excellent day.
Thanks for having us.
Thank you.